What's up, everybody? It's the beginning of a new month, which means you're going to see a bunch of videos out there on YouTube of people telling you their top 11 stocks that they're buying in October or top XYZ amount of stocks. I've got to talk about these 4 stocks, and hopefully through this you'll learn the types of stocks to most likely avoid. But these 4 stocks are going to zero if they don't get their costs in line. I want to make something very clear. I'm not short any of these companies. I'm not going to short any of these companies. I don't own them in my portfolio. Here are the companies I own. What I want to talk about is that I'm highly confident that these stocks are not going to return to their all-time highs, and very confident that they will literally go to zero if they don't get their costs in line and then somehow get back to revenue growth. But the path that I see them on is a path to zero. Let's talk about them. We've got Tattooed Chef, OTLY, Honest Brands, BYND, and I threw Pepsi in here to give you an example of how challenging of a market it is for these small brands. How much people, especially in a recessionary environment or when they're looking for ways to cut spending, they don't care as nearly as much what brand they buy at the grocery store, and they're gonna go with the cheaper brands. And in that scenario, brands at scale, the bigger brands with pretty much endless bank of resources and a strong balance sheet, those brands are going to win because they can afford to continue advertising, to continue paying to be, in the right spot in grocery stores and different things like that. Whereas small little companies like Tattooed Chef, OTLY, BYND, and even Honest cannot afford to compete with these larger brands, and we can see it in their numbers. And so what I want to identify here are traits to avoid in companies, traits that show that a company is on a path of destruction and potentially never to recover and to go to zero, right? So let's look at their returns, right? Tattooed Chef's down 73%, OTLY's down 82%, Honest Brand down 66%, BYND is down 86%, and that's just this year alone, whereas Pepsi is up, right? The first thing I like to look at when I look at stocks, okay, longer term, how are they performing? Well, there's not really a long-term history with any of these companies, but the longest we have is 3 years, and both Tattooed Chef and BYND are down. They're down 50% and 90%. So the history we have shows that these companies are losers, right? Now, look at Pepsi. So it's not just an industry-wide thing, right? Because here's Pepsi over the last 3 years, up 29%. So clearly, not everybody is just dying in the industry over the past 3 years. And then if we look over the past 10 years, Pepsi's up 207%, okay? Not a stock I would own, but I'm just showing it in contrast to these crappy companies right here. And nothing against these companies specifically. It's more against them as an investment and people who are out there pushing these companies for some reason as a great investment out there on YouTube. Okay, the first thing people might say, other than how much they're down and they're a great opportunity, is, oh my gosh, look at how low their price to sales ratio, or they could say PE, but they're all negative because they're unprofitable. So they might say, look how low their price to sales or EV to sales ratio is. 1.7 for Tattooed Chef, 2.2 for OTLY, 1 for Honest Brands, and 1.94 for BYND. Well, guess what? There is no price that is cheap enough for crappy companies that aren't going to recover and can't grow their revenue or get profitable. And here's where the problem lies. So we have Pepsi that has grown their revenue, billions of dollars in revenue year over year. They've grown almost 10%. BYND is not anywhere near that, and they're not even growing. They're growing 2%. Honest Brands is negative growth over the last year, and then OTLY and Tattooed Chef are at 31%, which seems high. But when we get to how unprofitable they are and how much they're paying for that growth, their business doesn't make sense and it's not sustainable. So the second that they go down on marketing and stop spending on marketing, sales is going to drop drastically. And so they're just in this inevitable funnel that they're never going to get out of because they can't stop spending on marketing. That's the difference between consumer product good brands and software brands or recurring revenue brands, is that they eventually can stop spending on marketing or as much on marketing because they're not constantly having to acquire as many new customers. Once somebody eats their meals with Tattooed Chef, they've got to go out and then win that customer again, and that customer has to buy those meals again, and they've got to pay to produce those meals every single time and pay to put them on shelves every single time. Whereas with a digital product or enterprise software, which is the type of companies I invest in, sure, they're valued at a rich valuation, but they're not constantly having to produce a new thing, pay to stock it somewhere, and then hope that customers continue to buy it, when another brand could come up, just spend more on marketing, have a cooler looking marketing campaign and better looking ingredients, and they start to take their shares, right? It's just a cutthroat industry, especially when you're competing against people like Pepsi. And then here's the true problem, right? Profitability. So gross profit margin for Pepsi is at 53%. Beyond is at 6.7, Honest is at 31, Oatly's at 17, and Tattooed Chef's at 6.4. There's just no room. There is no room for improvement right here. They cannot lower prices at all to bump up sales, because it just destroys their model. And then every metric we look at here is just terrible. EBITDA margin, minus 23%, minus 40%, minus 14%, minus 59%. Pepsi's at 18%. Net income margin, all negatives, except Pepsi's at 11.2%. Okay, and then if we go down, they also just have an employee problem. And so they're either going to have to drastically cut the amount of employees they have, and then you would think that would hurt their long-term sales. But Tattooed Chef is at minus $82,000 of net income per employee. Oatly's at minus $146,000. Honest is at minus $207,000, and Beyond crushes it at minus $300,000 of net income per employee. And Pepsi's at $29,000. And so here's the deal. Let's look at the cash on their balance sheet. $27 million for Tattooed Chef, $275 million for Oatly, $66 million for Honest, $454 million for Beyond, and $5.6 billion for Pepsi. Then let's look at their operating cash flow and cash from operations. Tattooed Chef is at minus 77 million over the last 12 months. Oatly's at minus 268. Honest is at minus 30, and Beyond is at minus $416 million. Pepsi's at 11 billion of operating cash flow. And so what this means is that these business models in their current state are unsustainable. And these companies are going to have to raise debt with higher interest levels, which I'm not sure how that's going to work out for them, or they're going to have to somehow get profitable, or they're going to get acquired, or they're going to go bankrupt. My bet is that the businesses do not get better, especially in this environment, and no matter how cheap they get, I am staying away from these businesses and these types of businesses that are in consumer packaged goods, and there's no identifiable path to not burning cash, burning through all of their cash and becoming profitable. If I wanted to own one of these brands, I would just own something like Pepsi, or look for something that was on a better path and had somewhat of a potential to become profitable. No matter how cheap they get, you can't get a stock cheap enough that is on a death spiral in terms of cash on their balance sheet.